Hey traders, Raghee here. As we are creeping ever closer to Friday's non-farm payroll, remember, three major types of economic data are going to create these hot zones, not only for volatility, these scheduled high-impact volatility events, they're also going to be the measuring stick for how the market is going to interpret the likelihood for more hikes after June, or certainly March hike, May hike, maybe June hike, and then going forward. The better the jobs picture looks, the hotter the inflation looks, the more stable the GDP is, it green lights the Federal Reserve to continue to hike. And we know they like to hike +1. They're always going to go a little further than they should, arguably to both sides, loose and tight monetary policy. So presume they're going to do that. And if the data suggests they can, well, that's going to concern stock traders. That's going to concern investors because this suggests more hawkishness to come beyond what we already know, which is March is baked in. May is really even baked in. June is quite likely. And then again, after that, the picture gets a little fuzzy. Well, I've just sort of described there in about a minute what we're all concerned about and why we're seeing some chop and hesitancy on the longer term. Why do I have this chart sitting on a 2-day, 5-minute chart of the S&P? Because this is what I like to do when there's uncertainty. Very, very easy approach. Shorten the time frame, right? Shorten the time frame. And what that means is when you shorten the time frame, you're also shortening the time horizon. In other words, I don't really care what happens between about 11:30 and 4 p.m. today. I don't really even care how the market's going to open tomorrow after non-farm. That wonderful apathy is something that belongs to day traders. And it's not all about just active trading. It's about really, at the end of the day, being flat, because that's all, in the truest sense, day trading is. Shorter time frames, yes, shorter time horizon, but being flat by the end of the session. So with that being said, the way that I like to focus on the day trading is what are those inflection points in the market that I can take advantage of. It could be volume based. It could be, of course, price based. We could have indicators telling us when the market is looking toppy, right? And it could also be, and this is something that a lot of traders don't know, so this is volume, price, but it also can be volatility. Now, a lot of traders don't know that you can place support and resistance based on volatility. In fact, it's really time and volatility. And what does that mean? Well, every hour of the day, there is a specific number of points that almost any symbol tends to trade. It's historical intraday volatility. And the idea behind that is if we know what a market typically does at a certain time of day, we can project resistance, right? Here's resistance and support based on it. So the bell rang at 9:30. I typically don't recommend a lot of traders that are day trading do a lot of active trading between 4 and 7 a.m. Eastern. And then the closer we get to the bell, be cautious, because once the bell is rung, we're going to see the increased volatility, the increased volume. That's the wider participation in the day. So almost all of my day trading goes from 9:30 to 11:30 where it's pencils down. So I have a 2-hour block that I'm looking at for opportunity. And this is the 2-hour block after studying thousands of trades, my own traders that I've taught this to. I have found, based on what I like to see, volume, time, volatility, price, that the first 2 hours of the day are easier to trade for most traders. Most traders are also better off avoiding the midday doldrums unless they have a very specific tactic for the market coming out of the midday volume and volatility doldrums. And then there's a very few number of traders that are exceptional at the close. But the open is easier. Why? Well, the old saying is probably true. Amateurs open the market, professionals close it. Who would you like to go toe-to-toe with? So I'm going to show you a little bit about how this, what we call the HPMR, works, okay? So first of all, between 9 and 10, we have a projected low and high based on volatility and time. And then you'll see it updates again. Here's that low and high projected between 10 and 11. Well, we wait for these updates, and basically the lowest support, the highest resistance, especially when we're in a neutral trend. See this right here? Neutral trend. You'll see here since the open to even right now, this is the end of my day trading day, right? It's been a neutral yellow trend. That's when we can look at the chop, the non-trending environment, and fade. What does that mean? I will buy into strength, I will sell into resistance, but where? This is how I determine that. Okay, this is how we look at where we will expect the market to exhaust. And as I'm talking right now, we're testing this area right here, and I wanted to capture this live so you could see it working live. Here's your resistance, right? Really nicely confirmed, by the way, but with the overbought high reading on the stochastic, and then that moved down into the lower area. We could move a little bit lower, but in this area, it makes a lot of sense to start to scale out, move the stop to break even, or maybe even a trailing, all right? Because this is volatility-based support. So I really wanted to show you what it looks and feels like. Look, we have a doji in this area, another doji in this area. That's the stall that we would expect would happen in this area, in this volatility and time-based area. So I just wanted to show you something different, something that you can think about. Am I thinking about volatility? Am I thinking about what time of day it is? And am I focusing on what really could be the best 2 hours of the day? All right, so this is one of the many tools that I use in my day trading: hourly price movement range, volatility, and time-based support and resistance. And by the way, in the futures room, I have the indices, HPMR, that I give to members, ES, NQ, YM, RTY. And in my mastery, we have a slightly expanded pack to include some ETFs and stocks and such. But again, the main thing is to understand where the broader averages are going, especially if you're a top-down trader like myself. If this has helped, if you have any questions, if you have any comments, if you have any requests, leave them down in the comment section here at the Simpler Trading YouTube channel. Smash that button, smash that like button on the way out. Let us know we're heading in the right direction with the content. And again, if you have any questions, let me know. I'll see you all in Charts and Coffee and in the next update. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.